This is the Asia Trade. I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian investors assessing a late tumble on Wall Street with the rotation out of big tech rolling on. Treasuries edging higher on signs of a resilient US economy. Yen traders watching the Tokyo CPI report out this hour for clues on a potential BOJ rate hike as the currency's rally continues to upend global markets. Plus, Chinese battery maker CATL on course for a jump in second quarter profit. It's a fresh gauge of EV demand. But take a look at how we're tracking as we get into the end of what has been a tumultuous week, mostly to the downside for the global markets, and it remains this rotation out of big tech narrative that continues to really pummel settlement. We do see a bit of a recovery in sentiment, though, going into the Friday session for Australia, at least 0.4% higher, where futures are sitting this after we saw stocks here down under tracking that global sell-off, tumbling the most in 6 weeks when it comes to trading on the ASX 200, off by just about almost 1.5% of the previous session. So perhaps a little bit of dip buying returning. Pretty lacklustre picture being set up for the start of trading in Tokyo. We've got Nikkei futures looking pretty flat at the moment. Of course, that weight of the surge that we continue to see in the yen, some of that uncertainty over what do we expect from the BOJ into the end of the month, will get perhaps a little bit more clarity to their runway towards that expected rate hike with the Tokyo CPI numbers out today as well. A50 China futures looking a little bit to the downside at this point as well. Dollar China trading at 2.2421, of course, with that currency fixing from the PBOC in view there as well. Take a look at how we're setting up for US futures. We did see that dip in the late session on Wall Street, of course. Again, that rotation trade, pretty muted moves at this point, a little bit to the upside for S&P 500 futures there. And we are also watching crude markets. Oil is actually seeing 78.29 for New York crude at the moment, but we did see earlier sort of more convincing rally there. That equity rally kind of counteracts the China demand story that's been dragging a lot of these metals as well as crude markets. On the good news side, we did have US economic growth accelerating by more than forecast in the second quarter. That was driven by consumer spending and business sentiment. From all this bringing Bloomberg US economist Stuart Paul. So, you know, so much talk has been building towards when and how much the Fed will cut, right? Are we at a point where the reality is that there's still, you know, pretty significant components of this economy that are looking pretty robust?
There are significant components of the economy that are looking robust, but I do want to take some of the shine or pour a little bit of cold water on today's numbers. Most of the upside surprise that we saw today in the Q2 data was driven by an upside surprise in government spending, particularly defense spending. About 1/3 of total growth in the second quarter was driven by inventory accumulation, and firms, I don't think, are trying to accumulate inventories in anticipation of future spending. And the consumption growth that we saw was primarily in housing and healthcare, things that folks can't really delay their spending on. So a lot of what we're seeing is really interest-insensitive demand that's been driving Q2 growth. I still think that a September rate cut is on the table, despite the upside surprise that we saw in the Q2 GDP numbers.
You know, on the balance of risks, does it seem like rates, the transmission side, it's sort of restrictive enough on the data that we're seeing?
You know, it is showing up. Yes, transmission has been slower than we've seen. That's due in large part to households refinancing their mortgages at rock bottom rates in 2021 in particular. But we are seeing a pullback in discretionary spending. Growth in households' discretionary spending accounted for just barely 1/10 of total GDP growth in the second quarter. And if we strip out things like transportation equipment and intellectual property, things like R&D, if we focus just on business fixed investment in factories and in machinery, there was basically no contribution to GDP growth in the second quarter. So yes, to your point, it's been a slower transmission of monetary policy, but we are starting to see the effects of monetary policy really showing up in the GDP data when we look below the line, when we look below the fold, and we really drill down.
What are you expecting from the PCE numbers?
So yes, tomorrow we're going to get our core PCE inflation. That's the Fed's preferred price gauge. Just when you thought things were getting fun with the GDP, we get inflation numbers tomorrow. And we are expecting to see headline inflation slowing a little bit, core PCE slowing a little bit as well to 2.5%. on an annual basis. Our monthly number, we're just a touch below 0.2%. So that monthly number will be consistent with the Fed's 2% inflation target, I believe, for the third month in a row. And so when we see the summary of economic projections come out next week after the Fed's meeting, we're not expecting to see much of a change in their inflation forecast. We're expecting to see maybe a little bit of an increase in their unemployment rate forecast. But the thing that'll matter most is just how much that median dot in the so-called dot plot moves, and whether the Fed is willing to show their hand, really lock in that September rate cut expectation by showing 50 basis points of cuts expected this year.
Bloomberg US economist Stuart Paul there, ahead of those PCBE numbers that we're watching for. Let's bring in for some analysis Andrew Slimmon, who's a senior portfolio manager at Morgan Stanley Investment Management. Andrew, great to have you with us. You talk about entering the most treacherous 2 months of the year when it comes to equities investing, certainly. How much of where this market goes next, whether this real rotation into something else, we've seen the rotation out of tech, certainly, but the next move, does it really depend on what we see from central banks?
I think so. I would agree with that. Look, if we were about to enter the most treacherous time of the year, which historically this is from end of July until end of September, I don't think you'd see small caps leading the way. I don't think you'd see a rotation from growth to value stocks, because value stocks are more cyclical and they tend to have higher betas. So I think the market is sending a message that it is beginning to anticipate a Fed rate cut, because I think that would be warmly received at a time of year when historically it's better to be, taking on less risk than what's working. So to me, it's screaming Fed cuts are around the corner.
Right. And does that narrative get challenged then for you when it comes to still pretty resilient outlook, pretty resilient data that we're seeing?
No, kudos to the Fed. What you're seeing, Stuart's right, you're seeing a slowing economy under the surface, but the economy's not breaking. You're seeing inflation coming down. So at this juncture, the Fed has engineered a slowdown, but not something worse. And so I think that's why it is providing relief for risk assets that need lower rates, but they certainly they don't work if the economy is collapsing. So it's a very good narrative, and that's why you're getting this rotation from the growth stocks into that have led into other areas. We'll see if it lasts, but I think that's what's going on, and I think it's going to continue.
It's that last bit, isn't it? We'll see if it lasts, because I do wonder how fundamental, how sort of existential is the rotation we're seeing out of Mag 7 and its cohort at the moment, or do you think this could actually just be an opportunity for dip buying? Because fundamentally, the pros and cons of pouring money into these AI-focused companies hasn't really changed in the last few weeks alone.
You're absolutely right. I couldn't agree more. Ultimately, what drives stocks is not style rotations. It's fundamentally what is going on with companies. And next week, we're going to hear from more of the big mega cap tech stocks, and I think they're going to remind us that their business is doing very well and they're very cash flow positive. So I think the fundamentals are there, but it's a healthy reminder that for those who only own growth stocks in the first half of the year, you can get over your skis in owning a lot of correlated stocks, and when the market goes the other way, you can get really hurt. So I think it's a reminder to own financials, industrials. But as I sit here today and I look at what hasn't worked recently, it is those mega caps tech stocks, and we're coming up to earnings when they're going to remind you their business remains very strong. There has not been a sign of a crack in the fundamentals that warrants, their weakness from a stock price perspective.
I wanted to get to some of your stock picks. Costco is one of them, and we have seen fundamentals kind of trading quite, on the charts, quite interesting, right? Is it oversold? Is that sort of one of the compelling reasons, or does it form more of the broader kind of macro outlook for the US?
Well, I just, at this juncture, I'm always interested in stocks where they've had good quarters, good reports, but this market has focused elsewhere. And if we were doing this meeting in early July, I would say, boy, oh boy, the AI story in June was all everyone talked about. So let's discuss some of the financials, because I think they're going to have very good quarters. Well, they did, and the stocks have responded. So I look around for other areas that haven't. And so a stock like Costco that, they continue to benefit by the fact that the consumer is becoming pickier, and they're rejecting the companies that were aggressive price takers, and Costco has not. So, but Costco is not a value stock. It is a conservative growth stock, and so it's been kind of left behind, even though their business is absolutely booming. Anyone that's been to a Costco lately knows that. And so it's an opportunity to take advantage, even though it's a high multiple. I think their business is very, very strong.
And you're stock specific when it comes to some Asian markets as well, right? Do you think the rotation out of Mag 7 could benefit perhaps some names in North Asia?
Absolutely. So like a stock like Taiwan Semi, you have a combination of a rotation out of AI. You've got presidential politics going on here. But again, their fundamentals are very, very strong, and they are clearly a big beneficiary of what's going on. So take advantage of that. So I don't, when people say, well, what part of the world do you like? I always say, well, let's talk stock specific, which, let's choose areas based on stocks and what companies are delivering on earnings, where we see continued upside surprises. And I think TSM is a great story right now.
China. Can you pick anything that's compelling out of Chinese equities at the moment as we see them continuing to kind of test the doldrums?
Well, I mean, what worries me the most is listening to the high-end French luxury designers saying, the ones that have high China consumption exposure are really suffering. And there's very little sign of a turn there. So it leads, as a global investor, it leads me to, be focused anywhere. At the end of the day, the two regions that have the best kind of earnings revisions is the U.S. and Japan. And those are going to be the areas that we focus on, less so in Europe and in China.
Andrew, really great to chat with you. Some interesting ideas there. Andrew Slimmon is a senior portfolio manager at Morgan Stanley Investment Management. Much more coming ahead on the Asia trade this Friday. Deutsche Bank's head of FX research joins us as the yen's revival upends global markets. Stanchart Wealth Management helping us navigate the Trump race, with Kamala Harris shaking up the election race. We'll also be reassessing geopolitical risks as the Israeli Prime Minister visits Washington. This is Bloomberg.
It is time for this war to end, and end in a way where Israel is secure, all the hostages are released, the suffering of Palestinians in Gaza ends, and the Palestinian people can exercise their right to freedom, dignity, and self-determination.
US Vice President Kamala Harris, they're speaking after her meeting in Washington with Israeli Prime Minister Benjamin Netanyahu. That's after President Biden's earlier meeting with him in his first talks with a foreign leader since dropping his re-election bid. Netanyahu thanked Biden for his support and pledged to keep working with him despite clashing over Israel's handling of the war against Hamas. Let's get more from our Bloomberg government reporter, Zach Cohen. And Zach, it's been an interesting kind of dynamic, right? Because with the address to Congress, normally we'd see the Vice President kind of presiding over that. I don't know if that was down to Kamala Harris's existing schedule or sort of an effort maybe to put a little bit of distance between what her potential foreign policy stance towards Israel would be and the President's. What do you sort of make of that?
Well, certainly the campaign schedule was a factor, but it also creates the impression that there's more distance between Harris, who is the presumptive nominee for president for the Democrats at this point, compared to Biden, who's the outgoing president from the same party. And so certainly you had, a staunch Democratic defender of Israel, Ben Cardin, sitting next to House Speaker Mike Johnson. And for the most part, all the chairs were filled in the House chamber when both the House and the Senate heard from Israeli Prime Minister Netanyahu as he thanked them for previous Israeli or U.S. support for Israel's war against Hamas. But Netanyahu, as well as Democrats, have a couple of different audiences here. There are certainly some that are very supportive of Israel, especially after the October 7th attack by Hamas on Israel. But they're also dealing with skeptics like Harris, who is the current vice president, somebody Netanyahu's sat down with, who would like to see an end to the war, like to see Netanyahu agree to the ceasefire deal that the Biden administration has negotiated in order to bring the hostages home and end violence in Gaza. It's a very tricky walk for not just Netanyahu, but for Harris as well.
Yeah, very tricky, particularly if she wants to keep, the support of the younger voters, right, who are very much sort of against how the past few months have turned out in Gaza. It's been a really vibrant scene when it comes to the memes that have been generated from her sudden candidacy. We've now also heard from Jennifer Aniston. On top of everything, can this translate into votes?
I mean, that's the $1 billion question or $100 million question if you want to talk about what Harris has been able to fundraise just in the last couple of days since taking over the top of the ticket for the Democrats. Young voters are a really important part of the coalition for Democrats. They are going to win not just the White House, but maybe flip the House of Representatives and maintain their very narrow majority in the Senate. Every member of Congress that I've spoken to, at least on the Democratic side over the last couple of days, well, most Democratic members of Congress have been saying that Harris brings more vibrancy, more energy to the ticket. They're seeing more donations. They're seeing more volunteer signups, whether that means, that they saw a meme on X, Instagram, or TikTok that then compelled them to do that. We'll have to talk to a couple more voters to find out. But at the end of the day, older voters tend to vote more regularly than younger voters. And so that's a challenge Democrats will have to tackle as they try to win all three of these parts of the legislative process in November.
How worried is the Trump camp at the moment?
I mean, this is not something they were expecting. I was in Milwaukee last week for the Republican National Convention, and certainly there was some talk of Kamala Harris there over those 4 days of programming, but most of it was focused on Joe Biden, who former President Donald Trump's campaign to return to the White House assumed would be their nominee. Biden was the presumptive nominee for Democrats up until Sunday. And so a lot of the messaging was built around that, not just on his legislative records and blaming him for, high rates of inflation, surge of migration at the southern border with Mexico, but also questioning his mental acuity. The president is 81 years old, and that was seen as a vulnerability, not just for Biden, but for Democrats down ballot going into November. That they don't have that anymore. And so we've seen Republicans pivot to focusing more on Harris's record, especially because she brings much more of a liberal balance to the ticket than Biden certainly did.
A Bloomberg government reporter, Zach Cohen, there with the latest. We're more ahead on the Asia trade. This is Bloomberg. Thanks. Take a look at how Treasury futures, are trading at the moment. We've seen Treasuries really gaining as the debate continues to rage over just the timing of the Fed's first rate cut, right? We've been holding on to that recent rally, weighing these signs of what really ultimately is still a pretty resilient US economy against the backdrop of calls for quicker easing from the Fed. Really, Treasuries across the 10-year, across the maturity spectrum remaining pretty strong in the Thursday session, although we're off perhaps some of the day's earlier gains. We did see the data showing that growth accelerated by more than forecast in the second quarter. Perhaps more important are those PCE numbers, which may or may not continue to reinforce the bet that perhaps the Fed will choose to wait until September to kick off easing there. But a lot of those sort of wages and aggressive easing from the Fed have been rising in the last few days on this debate as to whether we'll see a move next week. Well, Bloomberg opinion columnist and former New York Fed President Bill Dudley says the Fed has no reason to wait to cut rates. He told us the labour market is signalling warning signs of a recession.
The labor market is slowing, especially evident in the household employment survey, which is much weaker than what we've seen in terms of payroll employment. Over the last year, household employment's increased by less than 200,000. I think the labor market, and the second part of the labor market story is, of course, the rise in the unemployment rate. We were at 3.6% a year ago. Now we're at 4.1%. And these kind of rises in the unemployment rate are essentially warning signs. Every time the unemployment rate has gone up by more than 0.5% on a 3-month moving average basis, the U.S. has had a recession. This is a so-called SOM roll. Right now, on the SOM roll basis, smoothing it, 3-month moving average, 0.43% increase. So we're getting very, very close to triggering the SOM roll. Chair Powell himself has pointed out the risks now are very much two-sided, not one-sided. Inflation is much more benign, 2.6% for the core PCE deflator year over year, and we're probably going to get another good reading on Friday. So I think it's time to start to focus on the risks of the economy, the risks of the labor market, to minimize the risk of recession, which always occurs when the unemployment rate goes up by more than 0.5% on a 3-month moving average basis.
Bill, let's talk about timing then. This was Chairman Powell in Sintra, Portugal, so not even a month ago. He said, we have the ability to take our time and get this right because the US economy is strong and the labour market is strong. Based on your piece, just on the timing, they might already be too late to fend off a recession. Why are they miscalculating how much time they have, in your opinion, even though they have acknowledged what's developing in the labour market?
Well, I think they put not very much weight on the SOM roll. SOM roll's perfect track record since World War II, 13-0. But their view is that the reason why the unemployment rate is going up is because labor force is growing rapidly. So that's not as disturbing as if the unemployment rate was going up because people are being laid off. The problem with that story is that in the 1970s, we had labor force growth that was also extremely rapid. SOM roll held. So I think you want to stick with the SOM roll until it's disproved.
That said, Claudia Sahm of the SOM roll has actually come on and said, people put too much emphasis on my SOM roll, and actually backed away from using that as one indicator to really end all be all. Is there anything other than that that creates new urgency for this sudden pivot, really a week before the Fed's meeting?
Well, if the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in the employment and investment. So the striking thing about the SOM roll is not just the 0.5% threshold, is the fact that every time you've gone through that threshold, the unemployment rate's gone up a lot. The smallest increase when you go beyond 0.5% is almost 2 percentage points. So that just tells you that once things start to unwind in a negative direction, it tends to keep going. And that's why the risk here is significant.
A Bloomberg opinion columnist and former New York Fed President Bill Dudley there. More ahead on the Asia trade. This is Bloomberg. We are just getting a Tokyo CPI coming through on the Bloomberg. 2.2% is the year-on-year number for July. Expectations were for 2.3%, so actually moderating from the previous reading of 2.3% as well. If you strip out fresh food costs, it comes in at 2.2%, so bang in line with expectations and a little bit of an acceleration. Taking out energy costs as well, coming in a little bit softer, 1.5%, also easing from that 1.8% in June, and economists' expectations were centred at about 1.6%. Some of that will be a base effect as well. We did see price surges about 12 months ago for food in particular, also lodgings, which had that post sort of COVID era jump after travel subsidies were reduced. We also saw a recent cut in utility subsidies as well, which kind of pushes in the opposite direction. Higher labour costs also at play there as well, to see some of those broad-based increases. The question, of course, is what this means for the Bank of Japan. They will want to see kind of just that broader direction that wage increases are feeding through to higher prices. Let's get some reaction now with Tim Baker, who's the head of macro research at Deutsche Bank, who joins me now in Sydney. Tim, looking at this, does it kind of, I guess, move the dial either way for expectations for the BOJ?
Look, I think today's Tokyo CPI, I mean, not so much. I think they'll still gain confidence, even though it was a lower number for core, as you said, because you start looking at a 3-month annualised basis, it started actually picking up. It was the first half of the year where it had an unwelcome decline, kind of stayed the BOJ's hand. But now to be curling up, and you couple it with some of the wage growth data you've mentioned, already up to 2-3% depending on the metric. Inflation expectations are rising. You see that in the Tankan survey. So there's a good news story with inflation gathering a bit more momentum in Japan. So my economist thinks there's a 60% chance they hike next week. So it's going to be it's meaningful for those that have been paid Japan rates. For yen, I'm not really sure that's enough to turn the dial. I mean, we're talking about potentially likely a 15 basis point hike next week. US yields can move 15 basis points in a day pretty frequently, right? So it's not a big deal. I think for yen, it's much more about, does the Fed really get a move on with cuts? And even more importantly, what does institutional Japan do with their foreign asset holdings? If they want to start to repatriate, bring the money home, that's the big bullish yen story. I'm not sure we're seeing it yet, but it's something we're watching.
Right. So what are we seeing at the moment, the sort of front running, and does that continue depending on what happens next week?
Yeah, I think on the currency side, it's moved a long way already. I mean, I could see dollar yen down to 150 perhaps, up until a few weeks ago, really, until you've had this big fall in dollar yen. Dollar yen had been overshooting rate spreads quite a lot. That was a bit unusual. Perhaps we got intervention around that US CPI print. Positioning had got a bit extended. I went through Japan and America in late June, and look, everyone was bullish dollar yen. So I think you just got very stretched valuation, stretched positioning. It's come back a long way. It's still probably a bit higher, that cross versus rate spread. So, yeah, a little bit more downside for dollar yen is possible. But I think to convincingly crack below 150, you need the Fed to actually deliver, or we need to see much more in the way of selling of foreign bonds by institutional Japan. The last few months has been it's been modest. But does that pick up pace? Because the GPIF may indeed change their foreign bond allocation next year. And we've seen this story 5 years ago, but in reverse, right? They wanted to lift their foreign bond allocation 5 years ago, and they started buying right about now. So do they change their mind? That's the key thing that could really get dollar yen materially lower. Until that happens, we're still roughly in these kind of call it 145 to 160 range, I think.
I feel like you are in more of a buoyant move at the moment because we're talking about volatility is obviously good for your business. How messy does it get though? Because we've already seen that sort of drying up of cheap yen funding causing a little bit of chaos across carry trades and such.
Yeah, I think it's. Yeah, I mean, I came back from leave earlier this week, and look, my head's still spinning getting across all this. Right? I thought it was going to be a quiet time, quite the opposite. My conclusion here is that, look, I think it's mostly kind of a bit of a washout of extended valuations, extended positioning across markets, not just for currencies in the case of dollar yen. Has the story changed hugely? I mean, arguably we're getting close to good levels to re-enter carry positions, right? I mean, the dollar is still yielding plenty and yen's not yielding much at all. You look at things like Fed pricing for the next year or two. The Fed's priced to cut roughly as much or more than the G10 average. I think that's still a bit weird. We just had the GDP print overnight that beat. Okay, the US can cut aggressively like others if they want to, given the inflation pulse, but they don't have the pressure to cut as aggressively as others because their growth is so much better. So I worry that the market's actually, at least in relative terms, pricing too much in the way of Fed cuts. And therefore, is the dollar really going to weaken a lot from here? Additionally, you've got worse growth out of Europe. You've got more concerns around China. The US kind of still looks okay. US equities are probably kind of well supported. The dollar is a safe haven as well as a high yielder. I'm not sure that story is really hugely changed. I think I guess what I'm saying is I'm more likely to be fading these recent moves than chasing them.
Yeah, the fundamental weakness for China makes kind of the big move that we saw for the yuan ever more interesting, right? At one point, it was the biggest move of the year. If you take a look at this chart, this is onshore rather than offshore. It's sort of really hard to see a longer-term strength trend, though.
Yeah, for sure. So I guess our concern there on dollar CNH, again, a very popular long position for most of the year. So, how much does this unwind kind of continue? That's a risk. But yeah, fundamentally, it's hard to get bulled up on the Chinese currency. The growth story just keeps disappointing. I mean, the best you could say from the Chinese property sector, the much beleaguered, much troubled property sector, is secondary home sales are ticking up a little bit. But prices are still falling, so that's not great, right? I mean, okay, sales are up, but it's coming at a cost to what sellers expect for those prices. So that's a little concerning. That's hard to see. So it makes it hard for the CNH to get a move on. The other thing is that, it's well known that foreign direct investment into China as bad as it's been because, you know, deglobalisation, supply chain issues. But the outbound FDI out of China has actually picked up too, because Chinese companies realise, hey, if we want to export to the US and elsewhere, we'll probably have to set up a factory in Vietnam or somewhere else. So they're getting squeezed both ways by FDI, less coming in and more going out. So fundamentally, that's tough. For something like Aussie, I'm not quite as bearish though, because if I look at the Chinese economy, at least industrial production is doing reasonably well, and overall fixed asset investments doing reasonably well. So something like you know, Aussie versus CNH, I think still looks interesting. But China overall, yeah, it's still challenged.
Yeah. How much are you sort of trying to work out what the politics of the US is going to change? You know, like Donald Trump wants a weaker US dollar. His policies, if they're pro-growth, or will presumably be pro-inflation as well. So, you know, what does that mean for the US dollar, regardless of what he actually wants?
Yeah, big question, right? We're trying to sort that all out. I mean, Donald Trump, like many politicians, is solving for lots of problems, would like lots of things to happen. I mean, he wants a weaker dollar. He also wants the US to remain the premier world reserve currency. They're kind of in tension a little bit. He clearly wants more in the way of tariffs. We've seen this story before. That plays dollar positive. I guess we're a bit more focused on what he can actually do and what his priority is to do rather than what he says. How can he meaningfully weaken the US dollar? That's hard to do. Could you compromise Fed independence? Well, maybe, but that takes a long time to appoint enough governors if you wanted to do that. Could you put in some type of capital controls? Well, maybe, but then you diminish the reserve currency status. It just seems most immediately those tariffs come in, it plays dollar positive. The growth story still plays dollar positive. So, yeah, dollar kind of unchallenged for now, but look, it's going to be a big focus through the second half. A lot of moving parts, something to keep monitoring.
Yeah. Tim, always great to have you with us. Tim Baker, Head of Macro Research at Deutsche Bank. And taking another look at sort of another correlation that we've seen a little bit of unwinding when it comes to the moves in the yen, the correlation breaking down between the yen and the performance of the Nasdaq. That's what you're seeing on your screen at the moment, signalling the potential for more selling. That's a 14-week correlation turning positive for the first time in 3 years. So we're watching that very closely out of sort of the many ways that you can sort of interpret the week, the sort of turnaround that we've seen in the yen. But as Tim was saying earlier, potentially this sort of front running doesn't necessarily have fundamentally that much more to go, depending, of course, on what the Fed and the BOJ do next week. Taking a look at all of this is setting up into the Friday session, and we are seeing really a bit of a mixed picture there. We see that sort of recovery potentially when it comes to the Australian market. It was a pretty tough few sessions for Aussie stocks, and certainly we had that decline the most in 6 weeks in the tumble here in Australia. Futures are looking a little bit more positive at this point, about 0.4% higher. Japan stocks, though, looking like we'll see a little bit more pressure ahead with 0.2% lower trading for Nikkei futures in Singapore at the moment. Certainly that big move in the yen is also causing some risk aversion when it comes to equities as well. The Nikkei fell the most in 3 years on the concerns over the BOJ, the yen, but also, of course, this great rotation trade out of these big AI names as well. More ahead on the Asia trade. This is Bloomberg.
The automakers are under pressure. The auto industry is in a turmoil. It is true that the transition that we are going through is immensely challenging, and this is a bump. There will be other bumps. This will last for a few years. This is not a short-term turmoil.
That was Stellantis CEO Carlos Tavares. They're speaking to Bloomberg on the state of the auto industry. It's been largely a terrible week in global equity markets. Our co-anchor and host of the China Show, David Inglis, has been taking a closer look at what's going on. And Ding, you know, I feel like we only get to see you when it's sort of like a miserable situation.
Yeah. Well, that's why I rushed over with a fairly bright-colored suit and this pink tie, of course, to brighten up this Friday, because what I'm about to tell you guys is nothing short of extremely bearish. So, see, here's the thing, right? See, that was the Stellantis boss conversations taking place right now. So what we've noticed this week, and let me start up with, so we know what's happened with Brice, and you know we've seen a substantial rotation out of the crowded trades. So on your screens is how, and this is just a snapshot of what we saw yesterday, an extremely short list of stocks got absolutely punished for bad earnings, right? And even in the case of, and I know you'll talk Nissan in a moment too, even in the case of decent earnings, and a very good example of that was, I think, SK Hynix this week, absolutely got thrown out the window despite the good set of earnings. Just goes to show how trigger-happy investors have become, given how crowded some of these trades have been. SK Hynix is a good example, again, of the chip story there. So I've had a look at where we are in the earnings season. MSCI World, which is largely a developed market index. So I think we're about 350 stocks in, about 1,200 stocks in that index. So the aggregate surprise has actually been positive, so plus 4.5%. But the price reaction has been extremely negative. So on aggregate, it's about 0.5% down. I think 7 or 8 out of the 12 or so sectors have seen largely good earnings, but largely very bad price reaction, which I guess goes to show, Heidi, the underlying sentiment right now seems to be negative. But it also could be summer, and it's also the fact that some of the equity markets that have been sold off substantially this week have done extremely, extremely well, like Japan is a case in point, of course.
Yeah, which of course entered a correction yesterday. What other markets are you watching as well in terms of what other thresholds and milestones we could hit?
Yeah. Well, Taiwan reopens today, is my understanding. It's been shut, of course, for 2 days. So the TAIEX is, to your point in correction, right? So Japan entered that yesterday, 10% down from just a very, very recent peak. Taiwan is down about 6%. And just given how much catch down that market has to play, and largely a TSMC story, you know, I'm not saying a 4% drop is going to happen today, but a 4% drop should not be unexpected when that market opens up today. So a 4% drop gets Taiwan to a correction. Chinese markets have lost momentum. The Hang Seng Tech Index is about 17% down from the peak. Shanghai Comp on your screens as well. What I'd also note is, just going into the open today, so not just equity markets, this massive short squeeze in the yen. And it's, you know, the conversation right now is, fine, it's a short squeeze. We know the yen is a funding currency on the carry, and who knows what else that's funding out there as well. So is that a symptom? Is that a cause or an effect of this global rotation that's taking place? And dollar China, one other thing I'm watching today is that extremely sharp drop in dollar China yesterday. At one point, the steepest one-day drop on the onshore rate so far this year. So just a couple of things we're tracking going into the Friday session. Heidi.
China show co-anchor David Engler's always a bearer of bad news there. Well, we're going to stay with automakers, so keeping an eye on Nissan, as Dave mentioned, when trading in Japan gets started at the top of the next hour, just about 15 minutes away now. That stock fell by the most in 5 months on Thursday. Nissan slashing its full-year profit target. Let's bring our auto reporter Supriya Singh, who joins us in Tokyo. So, Supriya, talk to us about, I guess, you know, the realities for Nissan at the moment.
Hi. Yeah, so Nissan revised its outlook from 600 billion yen that it predicted in May to around 500 billion yen, which is $3.3 billion. Now, there are many factors that can be attributed to that, but I think the biggest challenge that company is facing right now is the high inventory in the US and the incentives that it has to provide to consumers to sell its cars. Nissan is also facing a tough competition in China, of course, from the local car makers like BYD, which have, you know, much superior EVs than any Japanese automaker currently in the market. Nissan also saw its sales falling 8% in Japan. So basically, in all its three main markets, the company is struggling, and that has to do with no new models from Nissan. And also, as we see that the global sales globally, the trend right now is shift to hybrids and not to EVs. And EVs is where Nissan had an edge in. It has been providing its best-selling EV in Japan, but now as we see the global shift to hybrids, the company doesn't have good hybrids to provide. So I think the US inventory, no new models upcoming, and then no good hybrids are the factors that Nissan is struggling in its main markets right now.
You've sort of gone through some of the challenges, right? What's going to be the next sort of catalyst that we should watch out for?
Well, yesterday, Nissan CEO Makoto Uchida said that the company will bring about new models, and that's how they're going to stabilize their sales and save their profits. But I think the market watchers really want to see now more updates on more announcement on new models. If that doesn't come up, I think they will be really disappointed. I think they also want to see, they're also watching for Nissan and Honda have to give on their potential alliance the companies said they have been working on. So I think if something positive comes from this Honda Nissan alliance on the EV project, I think that might be a breather for the market watchers. And they also want to see if Nissan is really on track to achieve its additional 1 million sales target that it set in May. So I think no sale falls and more models and updates on Honda is probably something that watchers will really be looking forward to.
Our auto reporter Supriya seeing that in Tokyo. Well, Chinese EV battery maker CATL is set to report second quarter results later on Friday. Analysts are expecting a jump in net income. Let's get the details now from our Asia Transport reporter and Danny Lee. Danny, some of the peers of CATL have missed estimates, but why are we expecting a different story here?
Yeah, I mean, CATL is more of I feel like a global bellwether for the EV industry and EV sales, right? And so really we're expecting to see CATL produce a rise in earnings, particularly on the net profit side, and still a fall in revenue. It really is all down to its cost base and its ability to drive down costs and its scale. So it's really benefiting from all of that, and the fact that its market share globally and within China being the biggest EV sales market, it really is supported either way. And where you see the likes of LG Energy, which missed estimates and sales did fall, they clearly have a challenge in the likes of Europe and in the US, which sales are more anemic. So I think CATL is in a much better position when it comes to the health of the global EV industry, and particularly how China is driving demand.
Is this all about scale in terms of what's driving these earnings?
I think fundamentally for CATL, it's all about its ability, yes, to scale, but the fact that it has so much exposure upstream. So where we have seen falling battery material costs, it's the likes of CATL which has benefited because of its exposure upstream. It has better control over pricing, and so where there has been pressure on battery prices, CATL is able to cut prices, it's able to maintain market share and grow market share, not just in China but abroad, and then be able to translate that into more robust earnings, whereas the other players, such as your LG Energies, where the kind of turmoil in many ways of the EV sales market, CATL is in a better position because of its exposure, yes, globally, but still within China.
Our Asia Transport reporter Danny Lee there in Hong Kong. Let's get you some of the headlines that we're following across the corporate space. And the Japanese developer of job matchmaking app Timee is listing on the Tokyo Stock Exchange on Friday. It raised $306 million in the nation's largest IPO so far this year, giving it a valuation of around $900 million. Timee is aimed at so-called spot work that matches employers with people seeking jobs for specified periods of time and locations. Bloomberg has learnt that Meta is facing its first EU fine over claims it's abusing its dominance in classified advertising by tying Facebook Marketplace to its social network. Sources say the EU order will be issued in the coming months. Regulators may also tell Facebook to make a separate version of its classified ads platform. Russia is throttling access to YouTube, one of the last US social media platforms still available there. A Russian parliamentary committee says download speeds will be slowed by 70% by the end of next week. The committee accuses YouTube of an anti-Russian policy and deleting the channels of public figures. YouTube has blocked some channels that are pro-Kremlin or run by the Russian state. More ahead on the Asia trade. This is Bloomberg. Well, the Paris Olympics opening ceremony just hours away. France ready for a festival of sport to provide some much-needed respite from the recent political chaos. Bloomberg's Caroline Conan reports from the French capital.
The Paris 2024 Olympics kick off on Friday night for the first time in real life after the pandemic kept spectators away from the Tokyo Games the last time. It's also the first time in 1 century for the French capital. Christophe Macron has called on Olympic troops after the last snap elections left the country without a parliament and no new prime minister in sight quite yet. As many as 15,000 athletes from more than 200 countries have already arrived in Paris, including from Iran, North Korea, Israel. They have in place the very high security. Russian athletes, however, will have to compete individually without representing their country. As many as 15 million visitors are expected in Paris during the Games, which could lift the French GDP to as much as 10 billion euros. 10 billion euros, that's also the cost of the Games. France has pledged to limit public spending for this Olympics. And for the first time in history, the opening ceremony on Friday night will not take place in a stadium, but in the city along the Seine River. As many as 6,000 athletes will sail down along a 4-mile stretch of the river with a big finale at the base of the Eiffel Tower.
Bloomberg's Caroline Conan there in Paris as we head into the Summer Olympics. Take a look at the two-day trading when it comes to the yen. We have been hearing from policymakers, the Vice Finance Minister Masato Kanda, speaking in Brazil, talking about the disorderly moves in FX with negative effects on the broader economy. This is the Asia trade. We're counting down to Asia's major market opens and a lot to contend with, not least of which, of course, we're starting to get some moves from central banks, including expecting that from Singapore. But of course, in the meantime, we're watching the big moves that we continue to see in the yen, and that's really sort of upended a whole lot of trades cross assets.
Yeah, so many things unwinding as the yen continues to strengthen. It's not just the things you'd expect either. Gold, Bitcoin unwinding. We've got the yen recovering, weakening a little again, 153.72. But yeah, really sending shockwaves through markets. But so many catalysts at the moment. The tech unwind as well.
Yeah, and so much of that, I guess, depends. You know, if we see the sort of true rotation, what does the Fed do? Certainly going into the PCE numbers, the second quarter growth numbers looked a little bit stronger than expected, so maybe that suggests that a hold until September could be what we're watching at. But take a look at how we're getting into the market open, and of course the Nikkei 225 Japanese markets entering that correction territory there. But we do have the Singapore de facto central bank saying no change to the width, the centre of the currency band. They'll maintain the prevailing slope of the policy band, seeing 2024 core inflation at between 2.5% to 3.5%. So they had been largely expected by economists to keep the slope centre and width of its currency band unchanged at the July meeting. And of course, we have seen that nominal exchange rate continuing to trade in the upper half of that band. So it does kind of signal that the status quo remains to be the appropriate settings. And that is exactly what Singapore has come through with, Paul. Yeah, that's right. A few lines here on GDP growth as well. The Monetary Authority saying 2024 GDP growth will be closer to 2 to 3%, sees both upside and downside risks remaining in terms of both inflation and also risks to growth there. But yeah, just to recap, maintaining the slope, the width at the centre of the currency band, so no change. We did expect this, of course. The expectation was that Singapore's just going to wait on the sideline to see what the Fed does. Yeah, we kind of continue to monitor some of the comments, right, because the expectation is that the statement will likely stay on the hawkish side. It sort of, meets, 4 times a year, and most economists had expected expecting that they would keep that tone, although they did preempt the Fed in tightening post-pandemic, it does seem now that the MAS is sort of looking to follow on the easing cycle there, according to economists being surveyed. Growth momentum in the economy should improve in the second half of this year.
Well, let's get to Steve Brice now, Group CIO at Standard Chartered Wealth Management, joining us in Singapore. And Steve, I just want to get your initial reaction to that announcement from the Monetary Authority of Singapore. No change, we expected that, but when do you see things are going to change for Singapore?
Yeah, I guess if you look at the macro environment, it's obviously from a growth perspective, it's relatively modest, but still healthy. I think the key thing are two factors. So firstly, obviously, is the inflation outlook. We've seen this week that inflation continues to moderate at a gradual pace. I think they'll want to get that down closer towards the low twos before they do anything on the monetary policy side. And then, as you mentioned in the preamble, obviously what the Fed does is going to be important, and what that means for the economic environment globally. So those are probably two factors that we're going to be watching out for. We are expecting to see the Fed signal dovish. Obviously, we've seen the comments overnight as well, but at the FOMC meeting next week, so really setting the stage for a September cut. That will feed into the MAS's thinking to some degree, but obviously they will be looking at that inflation number as well.
Yeah, we do continue to get lines coming in from the MAS now saying core CPI to fall further to about 2% in 2025. But Steve, I want to get your thoughts on some of the market action that we've seen over the past couple of days as well. That tech sell-off in the US continuing, just so many factors to weigh here, notwithstanding the strength of the yen as well. But those GDP figures out of the US were pretty good, and we've seen support for some areas of the market. So how are you leaning into this rotation trade?
Yeah, so a couple of weeks ago, we signalled that positioning in the US and particularly in the tech sector was getting to extreme levels, and therefore, we felt that we shouldn't be chasing the market higher and could see some sort of correction coming through. Obviously, the timing in hindsight was perfect, but I think the key thing now is to look forward and say, okay, so what are the factors that can stop this, right? So we're seeing a risk-off environment generated by repositioning and so-called Trump trade rotations. But looking forward, what is going to be really important, I think, is what happens from the Fed's perspective. So, at the moment we're seeing that people are still very convinced that we're going to see inflation coming down and interest rates coming down, and I think that environment should put a floor under equities in the relatively near future. Obviously, sentiment's still very negative after being very positive 2 weeks ago, but it just shows how quickly things can turn around.
I wanted to get to our question of the day, and it's a question I think on most investors' minds. This sort of swoon that we're seeing that's been driven by the shine coming off the AI narrative. Does this change if we get a more dovish Fed, whatever that looks like? Will that meeting potentially reverse the stock swoon, is the question, Steve.
Yeah, so I guess we think it will. I mean, if you look at actually the earnings season coming through from a tech sector perspective, we are seeing some beats coming through. So obviously earnings growth at the aggregate level still looks healthy, but tech is outperforming that, which you'd expect, and outperforming expectations. And if you add in that outlook for the Fed to start cutting rates in September, so we're expecting 2 rate cuts this year against that backdrop of slowing inflation, that should stabilise sentiment. So we see this as more of a positioning shakeout rather than the reversal of the long-term trend for today.
Steve, as we get this I won't call it chaos, but certainly some repositioning across major markets like the US, where the sort of exceptionalism story has prevailed for so long. Are you seeing this as an opportunity to take a look at international markets? Are there opportunities now that we have see this correction in Japan? What would you be looking at here?
Yeah, so we have if we talk about Japan itself, we have a neutral allocation to Japan. Obviously, we've seen some outperformance in recent times, especially in dollar terms, given the performance of the currency has kicked in to support that. Certainly the structural story for Japan, I think, still remains very positive. We're talking about a generational shift, in our opinion, from investing in bonds when we had disinflation and then deflation as the norm, now moving to consistent inflation, so people should be looking for assets that are protected against inflation, which obviously equities would fall into that category. So we do see supportive factors, so it should definitely be part of your allocation. But today we have a neutral. Elsewhere, I think from a China perspective, we're still pretty cautious. Obviously, we've obviously seen some monetary policy easing this week, but we don't think that's going to be sufficient to really change sentiment in a significant way. So the way we're playing China at the moment is focusing on SOEs that pay high dividends. That's performing very well, and we continue to see that as a focus going forward for investors. So that's how we'd be playing China today.
In terms of Japan, though, we've got a Bank of Japan meeting at the end of the month. What do you anticipate in terms of potential tightening, and what are the risks if the BOJ let this window pass?
I think it's, given where the yen is today, I think it's probably highly likely that they'll let the window pass and not do anything this time out, right? So I think if we've been kicking up 10% higher in dollar yen, then probably they would be sort of more looking to potentially do something. But given we've seen the correction now, I think they'll see that as effectively a tightening of monetary policy conditions, and therefore they can probably stand pat for the time being. They're still on the path for monetary policy normalization over the coming 6-12 months, but maybe they'll just hold pat for now.
Just in terms of the yen, we've got an interesting chart running on the Bloomberg terminal at the moment. It shows the correlation between the NASDAQ and dollar yen as well. This has only turned positive 4 times in the past decade, and it typically means the yen seen as a cheap source of leverage. When it turns south, the NASDAQ enters a prolonged sell-off. Do you see this trend playing out, or do you view this ongoing weakness in tech stocks as a buying opportunity?
So I think from our perspective, we do see the weakness that we're seeing at the moment. Obviously, we could still see further declines in the coming days, but we do see this as an opportunity to be averaging back into tech for those that don't have sufficient exposure. Obviously, from our perspective, the yen has obviously been a key funding vehicle that people have been using. Actually, the Swiss franc has been, we've been seeing almost more interest in the Swiss franc than in the yen. I think the challenge with dollar yen is, it goes up the escalator and out the window, and that's exactly what we're seeing at the moment, right? So, you don't want to be catching a falling knife when it comes to dollar yen, but ultimately we think that it will bottom out and then start tracking higher again. And that, to be honest, that fits in with the tariff policies that Trump would likely implement if he was to come into the White House, right? So, from that perspective, we think the dollar is likely to be reasonably well supported.
Yeah, and this sort of takes me to my next question, Steve. How closely are you watching US politics at the moment, and when do you kind of start positioning for, as you say, lots of questions about what a Trump trade looks like, or even a Harris trade at this point?
Yeah, so I mean, obviously we are, we did sort of highlight last week that we felt that financials look pretty good on the deregulation theme. Small caps are interesting as well, potentially from a tariff implementation perspective, but the short term or earnings outlook looks pretty challenging in that space. So it's not sort of an overweight call, but it's something that we're monitoring. I think what's really interesting from the election perspective is obviously Kamala Harris has had a honeymoon so far this week in terms of obviously closing the gap in the polls. That's the easy work in some way. Getting the nomination from the Democrats and then trying to solidify that and get some profile going. I think obviously the key now is going to be how does that unfold in the coming weeks? Does that momentum maintain and actually mean that there's a real challenge to Trump, or does this euphoria wane a bit and take us back to where we were a couple of weeks ago? So that's going to be really key, I think, for sentiment and for sectors in terms of what people are looking for.
All right, Steve Brice, Group CIO at Standard Chartered Wealth Management. Thanks so much for joining us for a very wide-ranging conversation. A lot going on today, and we want to check some of the movers in that regard as well, particularly in terms of some of these tech names in Asia. SK Hynix, well, it's flat right now, so the losses finally stopping there. Samsung Electronics actually modestly positive right now, but we're continuing to see quite a bit of weakness for Renesas. The tech-inspired sell-off in the US just rolling on as concerns linger about about the amount of spending going on in the AI space versus the revenue, which so far seems to be missing in action. Interesting, though, that we're seeing portions of the market actually show a bit of strength after that positive US GDP read. Also keeping an eye on Nissan. Okay, off by 3%, a little bit more than that at the moment. Of course, we had first quarter earnings and full year operating profit guidance, both missing the average analyst estimate. Just get you across a little bit of the market commentary. Citi, for example, saying a significant deterioration there in first quarter operating profit, and the company losing competitiveness, says Citi, having no HEV lineup. So bit of weakness for Nissan and the early going there. More ahead on the Asia trade. This is Bloomberg.
US Vice President Kamala Harris says she pressed Benjamin Netanyahu to accept a ceasefire with Hamas during her meeting in Washington with the Israeli Prime Minister. Let's get more from our Bloomberg government senior reporter, Kate Ackley. So, Kate, it was quite interesting. She was absent from his address to Congress, where the Vice President normally would be present, of course, and presiding. Is there a sort of an effort to try and put some air between perhaps her positioning on this issue and President Biden's?
Well, she did say that she was, sort of gave accolades to President Biden and, said that she was supportive of what he's been trying to do. But this really was putting her in the sort of international and foreign policy spotlight in a way that, her campaign for president is really just a few days old. So this was quite a spotlight. She came out, talked to, did a public statement for more than 5 minutes, reiterated her support for Israel, but also, as you mentioned, told Netanyahu, she said that she had, serious concerns for the humanitarian crisis in Gaza and, kind of articulated some of her own positions on the situation in Israel and Gaza.
Yeah, and turning to the campaign, Harris's sudden candidacy is generating something of a meme explosion online, but can this be translated into actual votes?
Well, you definitely are getting a sense of enthusiasm among Democrats. We cover Capitol Hill and, the U.S. Congress, of course, and Democrats in Congress, they have really changed their tune. They seem to have more enthusiasm about the ticket now, even though we only have half of it. We're waiting on a vice presidential nomination. Does that actually translate into votes? I mean, as you know, there are a few states in play, some swing states. And I'm sure everyone is looking over all the latest polling, and we'll be waiting to see that. But, Vice President Harris and the Democrats are going to go into their convention later this month. And, it's expected that they will get some amount of bounce out of that into the end of August.
How worried would the Trump camp be at the moment? We know that they're certainly not happy with the changing candidate, right? Donald Trump has gone so far as to suggest that they should get a refund.
Well, there is some litigation, about the campaign war chest that was the Biden-Harris, campaign war chest. Now has, the President Biden has said that money is now for the Harris campaign. And it seems like it can likely be a pretty seamless transition. And Harris herself has raised tons of money, tens of millions of dollars just since she became the likely nominee for the Democrats. But there is some litigation about that Republicans are challenging. Can she have that pool of money that was for the Biden-Harris campaign? Most of the political money experts that we've talked to said that it is most likely hers to use.
All right, Bloomberg government senior reporter Kate Ackley there. And we'll have analysis on hopes for a Middle East ceasefire coming up with advisory firm Red 6 International.
Take a look, Paul, at how futures in Europe are opening up at the moment. This is the picture as we head into the sort of earliest parts of the Friday session. Of course, it has been sort of an upending of expectations and narratives for global markets, right, not least of which the turmoil caused by the ascent now of the yen, as well as that shine coming off the AI trade. Futures, when it comes to Euro Stoxx 50, are actually looking okay at the moment, about just about 0.1% higher. German DAX futures looking pretty sort of flat at the moment. Luxury has really been kind of the major downside pressure across European markets, with LVMH, the concerns over the China recovery just really dragging down French stock underperformance even further there as well. Some pretty weak earnings as we get into the end of the week, with really the busiest reporting day of earnings season so far for Europe. We had a slate of companies, Kering, Nestle, all kind of fairly underwhelming. We could see perhaps a little bit more of bargain hunting as we get into today's trade. More ahead on the Asia trade. This is Bloomberg.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in employment.
Bloomberg opinion columnist and former New York Fed President Bill Dudley there. Take a look at what we're seeing when it comes to US Treasuries. We have seen the majority of that rally kind of being hung on to as we see a lot of turmoil across really the rest of these markets. But the debate continuing to rage on over the timing of the Fed's first easing move. But we're still seeing Treasuries really across the maturity spectrum over the past couple of sessions also really remaining stronger. Pairing some of the earlier, perhaps stronger gains that we saw, we did have the growth data suggesting that the US economy held up better than expected in the second quarter. We are going into, of course, a session that gives us the PCE numbers, so those sort of latest inflation readings will either change or perhaps reinforce bets that perhaps policymakers at the Fed will choose to hold until September, Paul.
Mobile app developer Timee debuts in Tokyo on Friday after an initial public offering that raised about $306 million. That's the most in Japan so far this year. So for more on this, let's bring in equity capital markets reporter Felipe Pacheco. So Felipe, what's the appetite for Timee like in the IPO?
Good morning, Paul. There was very, very good and strong appetite for the shares. During the IPO process, the shares were finally priced at the top of the offered range. We heard from analysts that there was actually, this is a quite unique stock. This is business model that is quite interesting, Paul. Basically, they match employers, people looking for someone to work for a very short period of time or for a very specific role, and the people looking for those jobs. And of course, this reflects a lot of what we know about the Japanese labor market at the moment. It's a place where you don't have, it's not easy to migrate to. It's not a market that's extremely dynamic when it comes to foreigners coming to work within the country. So this seems to be a very interesting startup. What we heard from analysts is that it is a unique business model that is now going to trade in the Tokyo Stock Exchange, and I think that the IPO process was reflecting that quite well.
What are we hearing from analysts, and what's the sort of the expectation as it starts trading?
Haidi, I think it's fair to say that people are expecting a strong start for this stock, not just because it was priced at the top of the range. Demand was quite strong, so that gives us an indication that there is room for the shares to actually trade up as soon as we have price this morning in Tokyo. When we look at valuations, for example, from what we see from analysts, they see that the stock has been priced in a way that it still gives some room for gains, like valuation compared to peers that are currently listed or that are comparable within the Japanese exchange. The price is seen as very attractive. What we know so far, we don't have a price yet, but we see that there are bids that are outpacing the offer for the stock. So I think it would be fair to say that we should see a quite strong start for the shares this morning.
So what's the pipeline for deals more broadly in Japan like at the moment?
You know, Paul, I think it's not as lavish and as strong as you would expect from the Japanese market right now. Stocks in Japan have been a very, very strong topic. Of course, there is outperformance from the Tokyo indices when you compare them to most of the Asian benchmarks. But at the same time, we don't see that translating to the IPO market. We had very few deals that were larger than $200 million so far this year. Timee is the largest in 2024, but still we are talking about nearly $300 million US. We had several deals in other parts of Asia, for example, in Korea, that were bigger than that. And of course, if you look at India, this is a market that's seen a lot of mid to large size IPOs right now. So I think it's still, Japan, of course, there is a tension, there's a lot of demand. The secondary market, additional share sales are very, very strong, but the IPO market is yet to reflect that excitement that we see in the overall Japanese stocks market now.
All right, equity capital markets reporter Felipe Pacheco there. Other corporate stories that we're following. Bloomberg has learned that Meta is facing its first EU fine over claims it's abusing its dominance in classified advertising by tying Facebook Marketplace to its social network. Sources say the EU order will be issued in the coming months. Regulators may also tell Facebook to make a separate version of its classified ads platform. Russia is throttling access to YouTube, one of the last US social media platforms still available there. A Russian parliamentary committee says download speeds will be slowed by 70% by the end of next week. The committee accuses YouTube of an anti-Russian policy and deleting the channels of public figures. YouTube has blocked some channels that are pro-Kremlin or run by the Russian state. More ahead on the Asia trade. This is Bloomberg.
Take a look at the yen trading that we're watching as this reversal of that long dollar short yen trade continues to create some degree of chaos across really a variety of assets. But taking a look at really the one direction that we're seeing there, this so-called crazy yen rally is really at the risk of shattering potentially as we get closer to the Bank of Japan and the Fed. Really the key to the currency outlook for both those currencies. And we've seen the impact on the likes of the yuan as well, seeing some pretty big moves to the upside. We are seeing the yen holding on to an advance of about 5% against the dollar since the start of that surge. That was just July 11th, right? Really amplified by a suspected intervention again by Japan as well. But we have had some investors, including some strategists, Tim Baker earlier from Deutsche Bank here, telling me that that rally could be quite fragile. That was on show overnight when we saw that rapid kind of retracing of gains, the retreat in the yen as we had that stronger than expected growth numbers out of the US as well. PCE is the next one to wait for to see whether we get that reaction in that pair. Tokyo inflation in the meantime accelerating for a third month in July, keeping the door open to a possible rate hike when the BOJ meets next week. Let's bring in our Asia Economy and Government Senior Editor Brian Fowler in Tokyo. So it was interesting data, more or less in line with consensus, maybe a little bit on the softer side, but is it going to be enough in terms of the longer term trend to convince the BOJ?
Good morning, Heidi. Yeah, so today's report, like any great data set, today's report has numbers pointing in all sorts of different directions, which keeps things pretty complicated. But let me try to simplify it. So, as you noted, the main gauge picked up just a bit in line with consensus, and that sends a greenish signal for a rate hike, call it maybe just a tinge of green. At the same time, we saw service price growth slow quite a bit. And that's a gauge that the BOJ is watching very, very closely. So that will definitely inject some caution into next week's discussions. But I would only point out that just yesterday we had nationwide data for service prices, the PPI for June, completely blowing away estimates to show growth at the fastest clip in more than 30 years. So I think the bottom line is that today's data combined with yesterday's report on the PPI definitely leave open the door for a possible rate hike. I would say it's probably something like 33 to 40% chance. I think that's probably in line with the market consensus at this point.
Bearing in mind you're talking about service prices there, is that among the factors that could persuade the BOJ to go the other way and just stand pat for a while longer?
Yeah, service prices is a really key point of this report, but there are some special factors to think about there. So first of all, in Tokyo, we had some education subsidies kick in a couple of months ago for high school students, and that's only in Tokyo, that's not nationwide. That weighed down on the service price growth in Tokyo. Also, we saw costs for hotels. They continue to rise at a double-digit clip, about 10%, but that's a much slower rise than last year when subsidies for hotels were completely phased out. So that's a base effect that doesn't necessarily point to weakness. It just shows up as weakness in the overall gauge. I think it's possible the BOJ could say, well, those were special factors weighing on service prices, and that does not necessarily reflect nationwide trends. So, I mean, we'll wait to see about that, but it's definitely a key point of interest.
You know, we were just talking about the fragility in this yen rally, right? The reaction to the growth numbers out of the US. We still have PCE to get through before next week. Is the BOJ likely to add to that in the case for hiking rates? How does that factor into their consideration at this point?
I think it definitely does, if anything, push toward a rate hike. We've seen politicians in recent days also advocating for a rate hike specifically to address the weak yen in order to put a cap on inflation. Of course, we did see the yen give back some of its gains after those GDP stats in the U.S., and we'll be watching PCE very closely tonight. But I think all things being equal, the BOJ probably would look at the yen as just one more factor on the side of going ahead with a rate hike next week.
All right, Asia Economy and Government Senior Editor Brian Fowler there in Tokyo. Let's stick with Japan, take a look at some of the movers on markets today. We do have the broader Nikkei and the topics both a bit weaker by about 1/4% at the moment. Although, see a little bit of green on the right-hand side of the screen there. That's the Topics Bank Index. Of course, those strong US GDP numbers, positive for financials, also energy, industrials, other areas as well. So it's not all about the tech sell-off also. But we've got mega banks in Japan due to report first quarter earnings next week. We're going to have Mitsubishi UFJ, Sumitomo Mitsui and Mizuho picking up or kicking things off. So when you consider some other factors there, Haidi, like the possibility of tightening from the Bank of Japan coming up, looks as if the situation's rather constructive for banks, and we're seeing that reflected in the Topic Bank Index.
Yeah, there's sort of a bit of a head-scratching moment when it comes to where next for Japanese equities, right? Because we've seen this big run-up. They've been kind of the global darling, and now we have this kind of reversal in the cheap yen trade, the funding, as well as the Nikkei, of course, falling the most in 3 years, and now with that 10% slump from the peak just 2 weeks earlier, we're now back in correction territory. We're sort of moderating losses at this point across Japanese markets at the moment, except for, of course, the banks that are doing a little bit better. More ahead on the Asia trade. This is Bloomberg.
Expectations are high, as we mentioned, for Japanese lenders. Quarterly earnings that will, perhaps for the first time, reflect the end of negative rates. For more, let's bring in Japan equities reporter Aya Wagatsuma. Aya, could there be some further gains here for Japanese banks?
Yes, this quarter especially there could be further gains, especially as the BOJ is expected to, they could raise their interest rates sometime next week. And the Tokyo CPI this morning, with inflation accelerating, shows that the BOJ may potentially, they could potentially raise their interest rates next week. So strategists like Invesco are saying that banks, brokers, and insurers in that order will be one of their favorites for this year as well. And it would banks will be able to gain from the interest rate hikes moment. Yeah. And also, especially because the banking sector is currently cheap at the moment. The Topics banking sector is currently trading 15 times price to earnings, while for the Topics index, the broader index is trading at 17 times price to earnings. So we see that the banking sector is a bit cheaper at the moment. So there will be further gains that we could potentially see for the Topics Banks Index or Topics banking sector in general. Yeah.
Is it just the mega banks that sort of the confidence is coalescing around? Because there, of course, have been some concerns with smaller and regional banks this year.
Yes. So if the Bank of Japan does hike their interest rates, for example, mega banks, of course, would benefit from this as well. But regional banks will also see more benefits as well. Especially with the regional banks, they will be able to see more, and also not just banks in general, but financials such as the insurance companies as well. They are currently unwinding their cross-share holdings, so that will also benefit them as well.
So things looking fairly constructive for the banks. How about other sectors that investors are looking towards?
Yes, investors are also, for this quarter earnings season, the weak yen has been continuing on. So exporters, the investors are also looking into exporting sectors as well. They could also potentially benefit from the weak yen from the quarter before, yeah.
Our Japan equities reporter Aya Wakatsuma there in Tokyo. And let's get back to one of our top stories and watching geopolitics. Vice President Kamala Harris says she pressed Israeli Prime Minister Benjamin Netanyahu to accept a ceasefire and warn him about the civilian death toll in Gaza during a meeting. This was her first since she entered the 2024 race for the White House.
It is time for this war to end, and end in a way where Israel is secure, all the hostages are released, the suffering of Palestinians in Gaza ends, and the Palestinian people can exercise their right to freedom, dignity, and self-determination.
Let's bring in Kirsten. Fontenrose is a president at consulting firm Red 6 International. She previously served as a senior director for Gulf Affairs at the U.S. National Security Council. Kirsten, always great to have you on with us. And it was interesting the way that this meeting was structured, right? Because she was absent from the address to Congress, and there was a lot of sort of speculation that this was strategic to kind of put something of a gap between her approach to Israel versus President Biden's. How do you view that? And I guess, how do you view the different candidates going forward, given that support for Israel, at least I guess, you know, going into the events of October, has been largely a bipartisan issue?
President Biden now has a chance actually to take a tougher stance with the Israeli government. He's going to drive hard for a ceasefire in his remaining months. And now that he's not bound by election era politics, he has a chance to deliver a little more tough love messaging than he has before. He also can play bad cop to Vice President Harris's good cop on the Palestinian issue in terms of the Palestinian view. Just the prospect of her potential presidency will make the Netanyahu government nervous. And it could take them in one of two directions. It could nudge them either toward making a ceasefire deal before she has the chance to condition U.S. military support for Israel, but it could instead push his government to accelerate the war, which would mean taking even greater risks with civilian lives. So it will definitely be something to watch how they react to her candidacy and to what she says on the campaign trail about the conflict. Thus far, she's been very empathetic with the Palestinian cause, and perhaps she and President Biden will continue to play good cop, bad cop on this issue as the campaign continues. In terms of President Trump, he definitely wants to push for peace in the Middle East, like he did during his first term, as many U.S. presidents have done. He does feel like both the Israelis and the Palestinians have been spoilers, and frankly, that both sides have yanked around the U.S. government during the Biden-Harris administration. You saw him tweet that he received a letter from Palestinian President Mahmoud Abbas, and the same day that Israeli Prime Minister Netanyahu was coming to Washington, D.C. to speak. That had to make the Netanyahu government sweat a tiny bit. And in 2021, he actually said he thought the Palestinians perhaps wanted peace more than Netanyahu did. But he also believes that Hamas has been allowed to call the shots during these negotiations, and that that is not how you treat a sanctioned terrorist organization. So I think you'll see him speak toughly to both sides of this conflict if there's not, in fact, a ceasefire and a hostage deal before we even hit the election.
It's really interesting because good cop, bad cop is exactly what I was thinking when I saw how strategic they were in terms of the Vice President not being at Netanyahu's address and then the separate meeting and perhaps taking a firmer stance there. So it sounds like regardless of who is in the White House from January next year, there's got to be tougher talk on Israel.
I think that's a certainty. If you have a President Harris, it for sure will be. And if you have a President Trump, it will be tough to both the Palestinians and to the Israelis with the insistence that let's get this done. You'll see a revival of what we'd call the peace deal that Jared Kushner had spearheaded. You'll see a revival of pressure on Israel to wrap up the war quite quickly if it's still going on. So I think whether it's President Harris or President Trump, you're going to see tough love to Israel. And if it's President Trump, you'll definitely see pressure on the Palestinians as well.
Kirsten, this idea of tough love, the desire to get things done, does any of it mean anything until Israel announces in some way that it's achieved its objective, which all along was to destroy Hamas? And until it says so, is any talk of ceasefire just premature?
Yes, talk of ceasefire as far as the Israelis are concerned is extremely premature until that objective is met. They are willing to do temporary ceasefires in terms of a hostage deal. For instance, this phase one of the three-phase plan that President Biden has put forward for bringing hostages back in exchange for prisoner releases from Israeli jails, returning Palestinian prisoners to Gaza. The Israelis said they could agree to this if certain contingencies are met, things like they want to keep some sort of military presence in the Philadelphia corridor that is south of Rafah, because they feel like this is where some of the remnants of Hamas are still hiding out, and they want the opportunity to dispose of those remnants should they come out of those tunnels. So you'll see their agreement potentially for a hostage deal with a ceasefire of 6 weeks, limited ceasefire, but they have in no way conveyed in any of their statements from any part of government any agreement to a permanent ceasefire or any agreement to a extended ceasefire, and instead have insisted that this conflict will continue until they do see the end of the military wing of Hamas and of Hamas's insistence on a political role in the future of Palestine. And to that end, they actually have agreement from President Trump, former President Trump, current President Biden, and Vice President Harris on that objective. You hear nothing out of either of these three power brokers about Israel being asked to stop the conflict completely and not complete this objective of eliminating Hamas's ability to strike Israel again.
Well, of course, President Biden's only got a few months left in office, which leads to the inevitable comment that, his is now a lame duck presidency. Although, is there an opportunity here as well? Because he has the chance, when not campaigning, to focus on what could be a legacy-defining outcome here.
Exactly. And you will really see him push for this. We're getting the sense that this is going to be a priority for him. He does not want his legacy to be that of supporting a conflict. He would like it to be that of bringing peace. And you have the continuation of his policies in a potential Harris presidency. So it's not as lame duck as perhaps a second-term president would be, for instance, where it was more likely that there would be a change in political party. Right now, it's 50-50 that his policies will continue under a Harris presidency. And frankly, a lot of the Trump presidency conversations are about similarly wanting to bring peace to this conflict.
All right, Kirsten Fontenrose, president at Red 6 International. Thanks, as always, for your observations. We have more ahead on the Age of Trade. This is Bloomberg.
We are looking ahead to the start of reopening in trading for Taiwan markets. We've had that 2-day shutdown caused by Typhoon Gaemi, of course. Let's bring our Asia stocks reporter, Sami Char. And Sami, in a lot of ways, it was probably a 2 days that traders would rather have off, given all of the volatility and their sell-off, right? TSMC is the one to watch at the open.
That's right. We've been seeing the sell-off deepen, that tech slump, and the Taiwan stocks actually have had a typhoon break for the last 2 days, while TSMC, it accounts for a third of the TAIEX benchmark index, which is 2.5 trillion market cap. It is a huge stock, and it wouldn't be an exaggeration to say that when you talk to a lot of the fund managers, a lot of their top holdings, those with the mandate in investing in China or in Asia overall, their top holdings are always TSMC, or one of their top stocks are always TSMC. So it's very important. And we've been seeing how the U.S. listed TSM has fallen massively, up 6% on Wednesday. And so although it inched a little higher, it closed a little higher yesterday, we'll be seeing how it reacts at this time around when it opens after the 2-day break. And that would be very important. If there is any of that fall, then that would actually prompt potentially the outflows. And that would actually be bad news for the Taiwan dollar, which is at the lowest since 2016 against the U.S. dollar.
Yeah, there have been some pretty compelling signs that equity investors are getting cold feet over the rapid advances in artificial intelligence leaders, and that's putting a spotlight on some of the less obvious beneficiaries of the tech boom. So can you tell us more about that play?
That's right. So the tech sell-off, as it continues, a lot of traders are looking at the unloved corners of the market to the small caps and the mid caps, and we've been seeing that everybody's talking about this rotation play. But at the same time, there is that coincidence of this AI expansion, AI theme expansion, where we see the beneficiaries not only in the software and the chip sectors, but it's going beyond that. It's a play on need for land to host these computing facilities for data centers and the massive power usage that is needed for this artificial intelligence. So when we talk about the power usage, then and actually this actually is supported by the data. When we look at the world MSCI World Index, we see that the top two performers are communications and tech year to date. But when we look at this quarter alone, they're the two worst laggards. But then from this July alone, we see that the two top performers are actually utilities and real estate. So power usage, well, the International Energy Agency says in 2026 we'll need double of that power used for AI adoption, and that's the equivalent of the power usage for entire Japan. So these companies that do power generation are going to benefit from this. And obviously when we talk about power usage, then it raises the specter of pollution. So that's where the renewables comes in. And China is well known for its alternative energy, adding the most percentage of alternative energy to its national grid. So, but because it's mired in a lot of the solar tariffs, hydro stocks like the China Yangtze Power are in focus as well.
All right, Asia Stocks reporter Sang-Mi Cha there. I want to get you across that Timee IPO that we've been waiting for. This is their job matchmaking app, which has just debuted in Japan, intended to help tackle the labour shortage by filling gaps with spot work for specific periods of time. This is mainly for clients in logistics, hospitality and retail, and yeah, being warmly embraced there, up by 21%. Interestingly though, Haidi, the company's not getting the proceeds. The shares are being sold by holders, although going public might help boost the profile of this stock.
This is all kind of wrapped up in what we're watching when it comes to Japan, and the other story, of course, remains the yen. Right, take a look at this 2-day yen chart, and very interesting that we saw that pretty rapid retreat in the yen as soon as we had that stronger than expected second quarter growth numbers out of the US. We've still got the PCE numbers to come to see if that sort of inflation print really convinces markets further that we could see a move from the Fed next week, or whether they'll hold until September. But certainly a lot of investors are now potentially looking at the fragility of this immense yen rally, 5% against the dollar since July 11th, that could very quickly reverse depending on central bank action next week. Taking a look at our major benchmarks, a bit of a split picture there, a bounce back when it comes to S&P futures there, a bit of catch down when it comes to the resumption of trading in Taiwan.